welcome back to another episode of Down the Middle. Today we've got another treat. They're all treats. I call them all treats because I enjoy them, and I hope you do too. But we have with us John Mousseau. He is President, CEO, and Director of Fixed Income at Cumberland Advisors in Sarasota. I'm actually filming in Boca Raton, so we're kind of neighbors of sorts. But more than anything else, John is known as being one of the country's absolutely best municipal bond fund manager. He knows the market inside and out, which is a great thing lately. We'll get into that, but first, I'd like to welcome John. Hi.
Thanks, Danielle. Thanks for having me.
It's great to be here. So tell everybody a little bit about Camp Coe Talk, because that's how we met. We met at Camp Coe Talk in the middle of nowhere in Maine.
You know, Camp Coe Talk, which is up in Grand Lake Stream, Maine, and is about 2 hours north of Bangor, Maine, and is hard as heck to get to. It started out years ago, and I was not at the beginning of it, but it was started out in the probably late 90s, if you will. And my first one was in 2001. But what it really was about 6, 7, 8 guys that were economists going up fishing and talking about economics. And it went over the weekend. And it went on for a few years. And then what happened like 2 or 3 years later, maybe in 2004 or so, the people from CNBC came up and decided to film it because they had heard about it. And Steve Leisman from CNBC came up with a camera crew. And the next thing you know, there were a lot of economists that wanted to come on this because it got a lot of play on CNBC. So it rapidly grew from 7 or 8 people up to a dozen, 15 people, and it kept going. And now it's up to about 50, plus a few others. And, we've had Bloomberg come up. Now we stream a lot of stuff, and it's turned into a big event. And, last year we didn't have it because of COVID, and I think a lot of people missed it. And it is the one time a year you get to talk to people that you normally wouldn't talk to, right? I'm not talking to other muni bond people. I'm talking to people that are Fed experts like yourself, talking to people that are hedge fund guys. Normally don't talk to them, or women who are hedge fund people. And the point of it is that what's said there stays there. And when you come out of that weekend, you come out of it with certainly more knowledge than you went into it. Whether it's applicable or not is one thing, but you're certainly a better overall professional for having gone.
I could not agree more. And it's you walk away with these insights, and you're kind of forced to put away your affirmation bias because you're speaking to such a wide variety of individuals. And I did miss it last year. That was terrible. But now we're breaking it up into 2 weeks. There's so much demand. So I'm counting the days.
Right.
It's my biggest hall pass.
Like anything else.
Getting on to more important matters. How did you get, you've never told me this, and I've never asked, how did you get the nickname of Moose?
Well, it's very short. It's my last name is Mousseau, so shorten that, it's Moose. My dad, who's been passed for 10 years, was the Big Moose. He was a dentist. I have had 3 daughters. They were all called Moose. I had a sister and 2 brothers, and they were all called Moose. So when we'd ever have our whole family walking together, I can remember walking through D.C. one day, the whole family, I think it was for my graduation or something, and someone yells, "Hey, Moose," and the whole family turns around. So, and that's even true with my family today. So it's hung on. It's nice to have a nickname that everybody knows. It's like Cheers.
So your dad was a dentist. What inspired you to venture into the world of finance and portfolio management, municipal bonds?
It's funny because he was a dentist, and had a chemistry background. In high school, I always thought I'd end up probably not going to dental school. I always figured I'd go to medical school, and I was well into the sciences. And my senior year of high school, I had a teacher that taught an economics course, and he happened to be the cross country coach, and I was on the cross country team. So I was immersed with this guy for like a year between coaching track and cross country, and also taking an economics course. And I knew within a month of starting my senior year taking this economics course, this is what I wanted to do. I didn't know what I wanted to do, but I know I wanted to do something involving economics and financial markets. And it never stopped. So I went to college, became an economics major, worked for the government, got a master's degree in economics, and filtered on down to New York.
Well, I'll have to share this story with my rising senior, who's going to be an AP macro micro. So that's going to be his introduction to the field for his senior year. So I'll let him know what might happen in his future.
It never stops being fascinating, right? I mean, you look at what we went through this past year, and the human element is horrifying, of course, but the markets element, when you look at financial markets, we're in an uncharted world. None of us have anything to draw experience on to compare it to, so there's a little bit of just going on instincts.
So I recently wrote about municipal bonds for the first time in years. I had no idea that municipal bonds were born from the Medici family in Tuscany, and that was, they had such power and pull that they could get better financing rates from the city-states. And that spread throughout Europe. And eventually in 1812 in the United States, and I find this to be fascinating, New York issued the first municipal bond in order to bridge Lake Champlain and Lake Erie to the Hudson River. So it was the canal that was built, and that was what put the New York City economy on the map. So
Right.
Explain, and that was followed by a series of scandals over the years as well.
Right.
But for the layman, can you explain what a municipal bond is, why they exist, and the role that they play today?
Sure. You know, basically a municipal bond is a certificate of indebtedness. They're issued by states, counties, cities, towns, and the backing of those bonds, what pays the interest on those bonds. Is it a variety of revenue streams, whether they're a pledge to pay in taxes, or they're a pledge to give revenues in terms of projects? Think about an airport where you have landing fees and vendor fees, et cetera, or a water and sewer bond where basically anytime someone flushes the toilet or turns on the water, the bondholder is getting paid. So, you know, the security aspects of it have differed. What has not differed for municipal bonds is they have effectively built the country that we know over the last 100 some odd years, right? And I think that's what makes the fascinating part of it. And as a professional, has always been one of the enjoyments of it, because there's very few parts of finance where you can look at the investments and know that they are backing not only the schools you went to, but the hospitals you got sick in, the roads you drove over, the water and basically sanitation systems that you use, and it goes on and on. And as a professional, there's a at least for me, a high degree of satisfaction in the fact that I'm involved in a capital markets process that has actually benefited the country at large, and state and local governments in particular.
So take us through the growth that you've seen in the market. Give us an idea of the scale. I mean, compare that maybe to the treasury market or the mortgage market or the corporate bond market.
Listen, you're talking about a $3 trillion market. And the biggest difference, obviously not as big as the treasury market, but the biggest difference compared to, say, the corporate bond market, where there's a very fixed number of issuers, right? From high grade issuers of corporate bonds down to junk issuers. It's a fairly finite universe. In municipalities, it goes from the largest states like California and Texas, who issue billions of dollars of bonds, down to a very small village, which might be issuing a $10 million bond or under, to finance a new sewer lines somewhere. And the old idea, and it's it was Tip O'Neill, the old Speaker of the House's line, but all politics are local. That applies to the municipal bond market so much so, because the controlling part of this is that how much to issue, when to issue, do we need to do that? It's all done on the local level. right? I mean, that's what's refreshing about it when you look at it. It's states, cities, counties basically solving their problems financially, or it's not solving, but issuing bonds to pay for things that, of course, have payoffs down the road in the growth of the cities, states, and counties themselves, right? Whether that's attracting businesses or financing schools for their students, what have you. So that's the part that's really different about it than any other thing. And it has grown remarkably over the last 40 years, certainly since I've been involved in the business. And it's certainly tied to population, but it's also tied to the growth in where that population grows. And you've seen that totally different in the last 40 years. And I can use your home state of Texas as an example. You went for years and years with migration out of cities, right? So think about the city of Houston, where you moved from downtown to people who moved out past the Beltway, out beyond the Beltway, out past the second Beltway. And that was the whole growth. And if you looked at municipal credit quality within that confine, you saw the migration, and the city's not doing as well, and the areas outside doing much better because that's where people were settling, et cetera. Then you went pre-COVID for the last 15 years, going the other way. People migrating back to cities, city cores being built up. When I first started, you go to Houston and there was very little going downtown at night. Everybody took off. The last 10 years, there's a lot of stuff happening downtown and people were moving back downtown. Same with other cities. So it was baby boomers, kids moving into the city, and baby boomers themselves retiring and moving back to the city or nearby. So it has implications for finance, has implications for crime. It has implications for pension funds. So, for example, the city of Houston's pension fund, which had some drawdowns and stuff, now it's people who have moved back in much better shape. So, as a professional, it's always important to keep on top of those trends.
So, the book was called Adventures in Muniland. First of all, we didn't quite get to the size of it. So I'm still curious, like, was it $1 trillion 40 years ago? Was it $500 billion?
Went from $1 trillion to $1 trillion to over $3 trillion.
Okay, over the span of the last 40 years. So
yeah.
What was the book about? Because a whole book about municipal bonds. So just help me out here.
Sure. And I mean, it started in the fact that when you hit the skids in 2008, right? And again, you were in uncharted waters, right? We had this financial meltdown basically caused by overhang of the mortgage, of the housing market, poor lending standards, et cetera. But the collapse really shook the financial market. So you were sitting there after Lehman Brothers collapsed in the fall of 2008 in September. And suddenly you had the rush to treasury bonds because the safety. You had the rush out of everything else, which included stocks, included corporate bonds, included municipal bonds. And so suddenly you looked up, and the reason I'm going this, it kind of sets the reason for thinking about
Sure, no, please.
Was you looked up by the fall or New Year's of 2009, and a long treasury bond was yielding 3%, and a long high-grade tax-free bond, even think about something like a Yale University, was yielding you 6%. That's insane. But that's the market, because it's the psychology of the market. And if you didn't have an economics degree, your psychology degree would probably be just as good for this kind of business. Is that what was driving that? It was fear. Fear takes over. Concomitant with that was the fact that you saw a big meltdown in the bond insurance business. The market had become akin to municipal bond insurance. And if you went back that time period 13 years ago, about 60% of all new issues had some form of a municipal bond insurance, which basically means if the issuer does not have the means to pay, the bond insurer would step up and pay. And that business had grown. And Whether you needed insurance or not is probably an open question, because I think the last 13 years have demonstrated you probably didn't need that much bond insurance. You needed on some. And certainly maybe on some lower rated credits. But what happened to the bond insurance business was the fact that, like any other property and casualty company, they insure credits, they collect premiums, they make money on those premiums. The rating agencies went to the bond insurers and said, we'd like you to diversify your book of business and not just do municipalities, which was the kiss of death for many of them, because they went out and started insuring things in Europe they didn't know anything about. They started doing some pools of mortgages, etc. So they, as my boss used to say, they got out of the shirt business and went into the shoe business and got their heads handed to them. So much so that those same rating agencies that said they would look more favorably on their ratings if they diversified their business cut their ratings, in some cases down to junk. What that meant is you took the underpinnings of the insurance away from the bond. So if you had a bond that had been insured by a poor insurer, it now relied looking at the underlying rating. So if it was a triple B hospital, it no longer had the AAA insurance, at least in a pricing model. This drove us to start thinking about all the things that had gone on in the muni business, the removal of the insurance, and then as you moved into the awful situation that Puerto Rico was in, and many other cross currents. So you had the meltdown in the markets, the insurers, Puerto Rico. This all happened over, say, 5 years, and that's what led to the book, because we looked around and nobody else had really written a book. There's plenty of books out there explaining about municipal bonds and how they work and the tax exemption of interest, but nobody had written a book about all the things that happened. And so we did that. We included many of our writings that we put in on it, but we tried to make it pretty real time from the financial crisis up through 2014, early 15 when the book was published. And it still sells a number of copies today. We give the proceeds to charity. It's almost time to write another book, and high on my list to do is write a book. I wouldn't necessarily call it Adventures in Muniland 2, because it sounds like a movie, but I would like to write a book about the bond markets and municipals in particular through the COVID, because the markets have changed so much.
So before we go there, can you explain, because it's still going on, a mutual friend of ours, Natalie Cohen, I ran into her at a party in New York City years ago, and she looked like she'd been through the dryer, and she'd had the longest day. And I was, what have you been doing all day long? It's a Saturday. And she said, well, I've been reading the Puerto Rican Constitution all day long. I said, what have you been doing? Why are you reading the Puerto Rican? So what happened in Puerto Rico?
It's simple. They issued too many bonds relative to the amount of resources that the island had. And I would tell you that the buying community probably looked past a lot of their financials. Back in the day, there was a fair amount of bonds that were insured in Puerto Rico. A lot of those are still being paid by the insurers because they happen to be among the stronger insurers. And they have continued to pay, and they've started to have some settlements. But probably in the time frame that you're talking about, which when you think about what Natalie spoke about in Puerto Rico, and I don't know whether she was working for her own firm back then or working for somebody else, but I'm sure what she was doing is walking through there and saying, are we going to get paid? I know, because I was doing the same thing, came to the conclusion, no, we're not going to get paid. But we came to the conclusion that if you own the insured bonds, you would get paid, because the insurance claim on a Puerto Rico bond read the same as if it was an insured bond for the Florida Turnpike Authority. So, but what Natalie described is the same thing that every good research person was doing in the fall of 2008 after Lehman collapsed. They would be taking home official statements, because they had them in paper those days, they weren't all digitized, and saying, geez Louise, are we going to get paid? And that's on high grade bonds. I mean, if Yale University is trading at 6% when Treasury market's trading at 3%, the tax exempt, there's obviously market collectively thinks there's a good chance you're not getting paid. And that's the nature of the dig down.
So how has this settled? How has this issue with Puerto Rico been resolved? Because I still see occasional headlines.
Sure. Think about it this way. You had not only the meltdown, and you saw this coming. So by 2013, in that fall, you saw the Barron's article, and it was a headline story about Puerto Rico. And like anything else, headline risk is one other risk you always deal with in this business. And that was probably the match that lit the fuse that started to the sell-off in Puerto Rico debt. And it continued that fall. They brought a $3.5 billion deal that following spring of 14 to try to patch up the waters, uninsured deal. It was wildly oversubscribed because it had 8% interest on it. And of course, immediately within a few months, those started trading off. And you got to 2016 when they actually stopped payment on their debt. And it's eroded since then. Since then, those bonds, which probably hit, a low point of like 25 cents on the dollar when they stopped paying, have rebounded to probably up in the 60 to 70% range. And why? You haven't gotten paid, but the prospects of a settlement have gotten better. As Puerto Rico got nailed, 4 years ago with Hurricane Maria, which set it back more.
Right.
But you have seen involvement. You've seen some private money come in. Things have been rebuilt. The highway authority has been rebuilt. The power system has been rebuilt. If you go to, and of course, stymied again by COVID, but prior to COVID, you saw people going back and having conferences in Puerto Rico. Good resort hotels were getting filled up.
Oh, I had a speech at the Vanderbilt.
Right.
It was right before COVID.
Right. So you saw that firsthand, and I think that's starting to resume. And before that, you actually saw it. A perfect example is the sales tax bonds, which never did stop collecting revenue because you spent money on something, you collected a sales tax, and it went into the coffers. What happened was the state of Puerto Rico or the government of Puerto Rico said, no, we own that revenue flow. And they took it and stopped paying the bonds. So those bonds stopped paying. Court cases evolved. They're still going on. That was one of the first bonds that, because it had a cash flow to it, that they achieved settlement with bondholders and insurers, et cetera. Are the settlements ideal? No. The people that are the bondholders are begrudgingly accepting less than 100 cents on the dollar because they know that's a better deal than collecting no cents on the dollar. Yep. And so settlements get done because someone wants to reach a conclusion and they don't want to be doing this 10 years from now. That's happened there. It's starting to happen now that COVID is hopefully in our rearview mirror with other credits. And we expect to see some settlements. And people, listen, in this country, you have seen people look at Puerto Rico, and particularly very wealthy people have started to move to Puerto Rico. Why? Because they're not paying federal taxes in Puerto Rico. By the way, that's not for everybody because most people aren't going to leave family behind and move to Puerto Rico. But if you have friends there, and if your family is grown, you may say, "I'm going to protect, 40% of my income for the next few years and move to Puerto Rico." And now, does the IRS start taking a look at that? Yeah, maybe. But right now, Puerto Rico is a tax haven for a lot of people.
So let's go back to Munis 101 for just a second. They are tax exempt. So the income that's paid, the coupons that are paid is tax exempt. Can you just walk us through, just to think of somebody who doesn't know what a municipal bond is, just walk us through how that works.
Sure. The interest that they pay, which makes the bonds attractive, because in a normal world, and actually right now the levels are normal in this sense, the coupon that is paid is exempt from federal taxation. And in all, but not all, but in many cases, it's also exempt from any state taxes. So the state of California issues a tax-free general obligation bond, full promise to pay. You are exempt from whatever your tax rate is on the federal level. and you're exempt from any taxes on California level, which is at 13.3%. That is a big deal, particularly in high tax states, for people to try to protect their income. That is why in most worlds, not all the time, not in 2008 when I described the 6 versus 3, but in most times that tax-free yield is less than a treasury yield and much less than a corporate yield. And why? Because you're enjoying the benefit of the tax exemption. Interestingly enough, for years, and I'm not a lawyer, but for years, the market always kind of thought that the history of the tax exemption and the ability to be not taxed by the federal government rested in the separation of powers of the Constitution. And back in the 80s, that was tested with a Supreme Court case that found, no, it's not in the separation of powers. It's really a function of Congress. Congress is the one who can decide whether the state and local governments are going to, have to, whether investors would have to pay taxes or not. And that has gone on. And, every once in a while you see someone say, oh, we need to make municipal bonds taxable. It usually gets a big rise out of the, state and local government officials lobby who want tax exemption to remain, because the idea of building this infrastructure, and we'll see whether the new infrastructure plan includes doses of tax-free municipal bonds with it. We haven't fleshed it out yet. But the whole point of any municipal bond is that you want to own it. You're willing to accept a lesser interest rate. There's a public good that's getting financed, and the municipality most of the time enjoys a financing rate that's less than they would pay if they have to issue taxable bonds.
Yeah, I can recall in my Wall Street days that the investment bankers' portfolios would be pretty darn simple. They would be triple tax exempt New York municipal bonds and Berkshire Hathaway stock.
Right.
So that was
no. It's interesting because when you get big debacles in the market, and you get them from one time. Back in the early 80s when I started, the big debacle was the Washington public power system. And they defaulted on debt, but not all of their debt. And there was a specific amounts that weren't defaulting because of the way the legal decisions were. They basically built more power plants than they needed out in the Pacific Northwest and eventually stopped paying on them because they didn't have the growth in people using the power that they would need. So they stopped building a couple of plants and they went forward on some of the other plants. The plants that were scuttled stopped paying the debt. The ones that they were paying the debt on, they continued to pay the debt, but the prices went way down and the yields went way up. And I can remember one of my first projects was buying bonds and different portfolios of bonds, paying 13, 14, 12% bonds in a world where the rest of the market was around 8 to 10. And I finally found out, I said, who the heck are these for? Oh, it's for Berkshire Hathaway.
Small world. So sometimes we hear, I've studied pensions for a long time. How do public pensions play into municipal finance? And separately, can you walk us through, because I think this is one of the least understood aspects. Last year during the election, there were all kinds of rancor and dissidents. And I remember one of the senators said, well, we'll just let the state go bankrupt. So I think that was a fallacy. So A, walk us through the effect public pensions have had on municipals over the years, and sure. B, kind of explain what the Constitution has to say about a city's ability, like Detroit, to declare bankruptcy, but the state doesn't have that avenue.
Right, that's a good point. So municipalities, there's no such thing as a Chapter 11. Again, not a lawyer. There is Chapter 9, which is a municipal bankruptcy. It doesn't apply to states because they're considered sovereign governments by themselves. So the state, whoever said the state can go bankrupt, really can't go bankrupt. And even in the places where, and I'll work backwards on your question, even in places where you've seen some bankruptcies. So you mentioned Detroit, that happened in the fall of 2014, went bankrupt, or Puerto Rico, which basically pulled the grenade pin in the middle of 2016 and stopped paying on their debt. And remember, there's a big difference. You can have a Chapter 9 bankruptcy. Puerto Rico just stopped paying. They just stopped paying.
That's just a straight out default.
They just default, right? So there's a big distinction between having a bankruptcy and just defaulting. In a Chapter 9 bankruptcy, you basically have to say, I have done everything in my power to pay off my creditors. In the case of Detroit, they went and said, hey, we have this much in pension expenses. We have all these, other expenses. Here's our revenue stream. They don't match. We need the relief of bankruptcy to do this. And it's a very hard thing to do, which is why even last year when someone was talking about, they talk about the state of Illinois or New Jersey, who have been kind of the poster children for bad state governments for the last few years. The state of New Jersey, which is I lived there for many years. It has lots of resources at its disposal. What it has is a pension fund, which has a lot of expenses, et cetera. If you were actually to go and say, hey, we're not doing a Chapter 9, but if you could do a Chapter 9, if you could have a state do a Chapter 9, you would have to go up there and say, we have done everything in the world to try to satisfy our expenses and sell stuff. Well, you could sell the New Jersey Turnpike Authority, which the state owns. You could sell the Garden State Parkway. You could sell off a lot of office buildings. You could sell off parks that the state owns and sell them to developers. There's lots of things you can do, but they're not doing it. So boil it down to a city like Detroit. There's lots of arguments there. I would say, as not a bondholder because we didn't own them, but if you looked at it, you'd say, oh, someone said, hey, the Detroit, art museum has tons of fine art they could sell to satisfy some of their debts. Judge said, no, they don't have to do that because that's really hurting the spirit of the city, et cetera. I don't know. It's an asset like anything else. They didn't sell office buildings. So what happens is, and this is why credit analysis is so important, is in the end, most municipal judges are going to say, to sell off these assets, which they should do legally to satisfy their debts, they don't want to make them do because it puts the city so far behind the eight ball in trying to regrow itself post-bankruptcy, which is why some of this stuff goes forward. The lesson in that story is you have to be careful as a general obligation bondholder because even though the legal documents say you have the right to all of their sources and they would have to sell stuff to pay you, in the end, you're just another unsecured creditor because in practicality, you're not paid to. Heading into what you said about pensions, pensions have been a big issue over the years, right? The problem with the municipal pensions in general is that the people that are deciding them, who are the officials in the state or city governments, they do a lot of, generous pension benefits. They're not around to see the mistakes that they've made down the road because they're out of office or voted out of office or retire from office. So they make those decisions. When you look at some of the pensions, and I'm not picking on any particular one, but there's plenty of horror stories out there of, people retiring and their pay is either a function of their last year of pay or it is their last year of pay going on forever. I mean, the pension issues are obviously in certain cities and states, and they're big. And part of it has also been, hey, we have generous pensions because municipal employees are paid less than they would get in private industry. And there's an aspect to that that's true. But the runoff, when you look at some of the things that are promised, is crazy. Now, the management of those pension funds is far from, perfect either. And that's been part of it. I mean, if you went back to the late 1990s, and if you remember the tech bubble back then, and things were really doing well on the stock market side. You had a fair amount of state pension funds, not all, but some, that went down and looked, and with the run up in the stock market, et cetera, their pensions were fully funded. This is only going back 22 years ago. Fully funded.
Yep.
Actually, more than fully funded. They had a surplus. So, and not being a pension expert, I can tell you though, if you get to a point where you're at a surplus, you've won. You've won the ballgame. It's time to take some of that surplus away and lock it up, because you've won. In other words, don't let things erode. And what happened in some of these states? They doubled down. They issued pension obligation bonds. In other words, bonds that were backed, full faith and credit of the states. And they took that money and reinvested in the stock market. We know what happened to the tech business. And the confounding thing about it is, if they had taken the surplus or even more, they could have bought 10-year U.S. Treasury bonds at 6% back then and locked it up. Or some higher grade corporates at 7%. And the point of it is, they went just the opposite and doubled down. And what you really wonder about is, where the heck were the actuaries at those times, passing muster on this stuff? And listen, that's an issue. They are paying the price for that even today, because even with the rebounds in the stock markets and things we've seen, we know that we had the meltdown in the tech market, but we also had this seemingly unlimited growth in pension benefits being paid out. And it continues to be a problem to this day. Most municipalities have come through the COVID pretty well. And so net, even some of the states that were in trouble look better today financially than they did before COVID. Why? Most states can thank the Supreme Court for the Wayfair decision a few years ago, which allowed states to collect sales taxes at the point of sale, which is their citizens, regardless of who's selling what, wherever they're selling it from. That made a magnificent difference in flow of funds to many states. That is why, for a large reason, the state of California, for all the turmoil that it had on the human side with COVID, on the financial side, benefited from everyone staying at home, buying stuff on the internet, and collecting sales tax. And on top of the capital gains in the stock market and the fact that incomes are going up in the tech area, et cetera, California looks down and sees a $15 billion surplus. So my thought is that Governor Newsom, if he can beat back this recall that people are trying to do, I think his next order of business would be to make sure the legislature doesn't go and spend that surplus and tries to put part of it into a rainy day fund. We'll see. If Jerry Brown was still the governor, that's what he'd be pushing.
So let's step back from the municipal market for a minute and give me your 40,000 feet above the air view on the big question of whether debt and deficits matter.
They matter if you take the longer view, right? So in other words, think about the U.S. We've been able to finance our way through a lot of this. What has really helped this country do that? One, like other places, we're a reserve currency, right? So people will accept our debt and have. So we just issue, and they're promises to pay. Not like the old days when the dollar was backed by gold. The interest on that debt has been, in terms of the interest cost, has been fairly benign, because so much of it has been short-term, and we know short-term rates have been fairly low for a fairly long period of time. So you have two components there. You have the interest expense, and the main point, as we know, is that the interest expense as a percentage of the GDP in this country has been low. I think, and in not just this administration, but you go back to the last administration in the White House, the Trump administration, almost everything that you saw come out of this, and I would put this infrastructure bill in the same category, depending on how it gets fleshed out, is to spur on growth, because if interest rates rise, that expense of the debt starts to become larger. But if the economy is growing as a percentage of the economy, it doesn't become the thorn in the economy. If the economy is not growing, but that interest expense continues to grow because short-term interest rates are rising, that interest expense starts to serve as a wet blanket on the economy and holds things back. The other thing that can hold things back is, like, what if some of our larger partners around the world decided they didn't want to own U.S. debt? My guts tell me that doesn't happen, because if they caused an event that would cause interest rates to go up sharply, that would reduce the value of all the debt that they're continuing to hold. But, that relies on the politics that are in these countries too, and we know that can change. And we see it in China right now, between the forces at work of the existing government, but also the fomenting of human rights that we've seen in Hong Kong, et cetera. Who knows what the government's going to look like in 10 years? May look vastly different. They may have a different attitude towards that. That's why I'm saying, if you take the long view on this stuff, you'd like to see, some reduction in the amount of deficits here. If you look at this country and you look at it at a broad level, and our friend Jim Bianco has great charts on this, you can look and see big government deficits like World War II. Hey, our deficit in COVID, which we spent unlimited amount of money on, it seemed, right, still, as a percentage of GDP, wasn't as big as it was during World War II. That deficit, which was markedly down, was markedly large, started to go away as you got into the late 40s and the economy was booming, right? And by the way, we had some pretty big inflation numbers back in the mid to late 40s that doesn't get written about quite a bit. And that's because what happened? All the soldiers were home. They're looking for housing. All the things that were rationed during the war, gasoline, rubber, certain foods, et cetera, were in big demand. There's some echoes of that right now going on, by the way, and from an inflation standpoint. But what happened is the economy boomed, taxes were collected, and back then the attitude was we didn't want to do that much deficit financing, so the country went to surpluses. Then we went to deficits in the Vietnam War, back to a surplus during Clinton, and really since 9/11 and what we've spent, we've been in various modes of deficit financing ever since. The economy has done very well, so a lot of people would say, "Oh, the economies have done well. We can just run this out forever." Our kids. My kids are a little older than your kids, but our kids are going to have this issue down the road to deal with. And the idea that you're just going to continue to roll this up, it's a fact that I'm old. The economics that I learned wouldn't allow that to go on forever.
Mm-hmm. Well, you let the inflation genie out of the bottle. Where are you on this? It was interesting. We got fresh data out on personal spending, and adjusted for inflation, it was down 0.4%, which was a little surprising. That was 4 times worse than what the estimate was. And we're seeing the saving rate start to come down. We've also seen Fed data that show that the vast majority of the $1.2 trillion in savings that was built up is in the hands of people 65 years and older. So with that as a backdrop, if you will, where do you see this inflation debate headed?
I see it continuing. I think it has to run out. We have the argument, and believe me, at Cumberland Advisors, we have this argument in-house all the time. The question is that in the Fed's views, transitory, which is a pretty fancy schmancy word for temporary, is it transitory inflation? And does it start coming back down? And if you look, and depending, it doesn't matter whether you want to use PCE, which was a little higher by 1/10 today than expectations, or you want to use CPI or PPI, take your pick. And you say, okay, it's higher. And remember, we don't care about year-over-year numbers, because we know that if we go back and take away last year, 2020, March, April, May, which were like 0, -1, negative, or -0.1, -0.5, whatever the numbers were, they were all 0 to negative numbers. You're replacing them with positive numbers now. So by definition, those year-over-year numbers are growing. And the market knows that, and the market is discounted that. What the market doesn't know is what's going to be the month-over-month numbers as we go forward here. And like a lot of places, I can tell you people that in certain business roundtables I'm in here, the biggest problem is getting labor. So, for entry-level jobs that might be laboring jobs for developments or people putting additions on houses, people working in restaurants, people working at resorts. Used to be in Florida, starting salaries, wages were like $13 to $15 an hour. Now they're paying $17 to $21 an hour. And by the way, if the workers are there a week, they're giving them a raise to keep them. I heard a story last week. Guy brought in 2 cooks. They did a good job for 2 weeks. So we have to go use the restroom. Didn't come back. So it's that what's going on. That gets embedded, right? So if you're sitting there and buying lumber and it's gone sky high, we already know that lumber's come down a third. And I wish I knew who said this, because I've heard my boss David say it, but I don't think it was his phrase. But the best cure for high prices is high prices, and those things tend to self-cure as supply comes out. Wage increases don't come down, or they come down very slowly. And what I'm worried about is, how long does the market accept a 1.5% 10-year bond as you continue to print higher monthly numbers? If those numbers come back down, because remember, for years, if you went back years, the core CPI number that came out, and we can argue which inflation number to use, but I like that one. It's always been for months and months and months. It was 0.1 or 0.2. You had a couple of months of 0.2, you had a couple of months of 0.1. The net of it all is that you were always somewhere around 2, a little below, a little above. And you'd been there. And bond market yields would fluctuate, of course, with some of the projections for growth going forward. If the economy looked like it was doing better, they brought yields a little higher. If it looked like it was softening, they brought yields a little lower. What didn't change a heck of a lot was the CPI numbers, the core CPI numbers. Now they have changed and moved forward. So now you printed a 0.9. That doesn't last, but then you print a 0.6, then you print a 0.7, then you print another 0.6. If your reduction comes down and the run rate tends to be 0.4 or 0.5 or 0.3 or 0.4, as opposed to the 0.6 and 7 that you're printing now, but not goes back to the 0.1 or 0.2. Now you're talking about a run rate of inflation when you get there that's going to be somewhere between 3.5 to 5 or 3.5 to 4.5. How long does the 10-year bond stay at 1.5 when you're doing that? It can stay below the rate of inflation for a long time. If you go back and look at the 70s, when inflation really got the hell out of control, you had periods of time in the early 70s, or call it mid-70s, where inflation was well above the 10-year bond yield, but then came back down. It almost looked like a giant hump, and the 10-year bond yields did the same. The bond markets became self-learning a little more, and the next time inflation moved up, bond yields started to move up. And then inflation moved even higher, and it took a little while. It's like, oh God, they can't stay this high for that long. But they did. And then the bond yields took yet another leap up as we got to the late 70s and early 80s. And then inflation, as we know when Paul Volcker took over, started to come down. Why? Because he's raised the hell out of interest rates, and the bond markets took the cue from that. And bond yields stay much higher than inflation for at least another 7 or 8 years until they believed that inflation was actually on the decline and dead. So it's a long-winded way of saying is I don't know for sure, but the run rate of inflation as we go out forward is going to be really important. You mentioned, the basically in another way, the money supply that's out there, which has come down a little bit, right? And at the margin has come down and maybe responsible for some of the decline that we've seen in that 10-year bond yield going from a 175 down to this 150-ish level. but it's still there. And what we don't know is we don't know what the turnover of money is. So because you're still in this period of time where we're just coming out and we're not experimenting, we're seeing the turnover of money pick up. And how much does it pick up? And how much of it is that a cause of inflation in the price level, the old Irving Fisher idea, which I happen to believe in. So you think about now you're gonna look at AT&T Stadium in Dallas this fall, filled with people for the first time in a couple of years. That's not last year. It was just the Cowboys playing in there with only a few fans. This is now full ticket revenue, concession revenue, parking revenue, and that money gets turned over, and that money gets turned over to other people and gets respent, and that gets respent. And you can replace that example with a cruise ship out of Miami. You can replace it with a convention center in Las Vegas. You can replace it with dorms of colleges filled with students this fall. And the analogy is the same. So I don't think we know what the money supply, which has been skyrocketed but is declining, how that combines with a turnover of money, which has been low, and we know is going to pick up and probably pick up even more.
So in the interim, we've got this debt limit negotiations that are going to be going on, which kind of takes you back to 2011. Given it looks like I think somebody on my Twitter feed today said that Mitch McConnell would give a kidney in order to get the gavel back, and we know that it's going to be very rancorous and a very hot summer. But we also know that the country has more money on hand than it normally would heading into a situation like this. Janet Yellen has a bigger cushion.
Right.
But
what are your expectations for this, and how it affects the economy?
I think, and I do agree with your assessment of Senator McConnell. I think he'd love to be back in the driver's seat. I think as you go towards the 2022 elections, with the exception of the more left part of the Democratic Party, I think most people are going to be looking at, as people come out of the hibernations and are back working, back in their office, some of the traditional views come to go forward. If you're sitting there at home and you're out of a job, you want all the money spent in the world, right? If you're back working at a job, you may say, geez Louise, I don't want to see my taxes go up a gazillion. I want to see maybe a little less spending, et cetera. So as you head towards the 2022 election, I would say on average, the person running Democrat or Republican doesn't want to be seen as the person that wants to be on the last spending spree. So I think what President Biden gets out of this package with the infrastructure and any other spending, I don't want to say it's the last hurrah of the administration. I think it's certainly the last hurrah before the 2022 elections. And I think that's going to have a dampening effect. And listen, as we all know, it seems like when you have an election, the next order of business is how to win the next election. And I do think there's a fair amount of I wouldn't say conservative, but less liberal Democrats that want to join to find a solution. I mean, this bipartisan group of 10 senators, I was thrilled to see it because, anytime you see cooperation, I'm like, yes, boy, that was, whatever your political stance, we can all argue that was truly lacking in the last administration, for better or for worse. The fact that Vice President Harris just invited all the women senators, regardless of party, to her house. I said, yay, that's great. Because, when we were growing up, or certainly when I was growing up, I'm a little older, is that you had this spirit of cooperation. And I truly believe that a lot of it is based on the fact that our parents only knew 3 networks of network news. And you had basically more or less NBC in the middle. CBS was a little more liberal. ABC was a little more conservative. But you were never far outside the center. And since then, between the growth of the internet, satellite radio, blogs, etc., the extremes have had so much foment to them that you've pushed the middle so far out, and you have what we have had. So I believe in reversion of the mean in everything, and I think it's in politics too. So I'd like to think that you see some level of cooperation there. And for a president to spend so much time in office himself and still knows a lot of the senators that are in office, some of the older senators, from his time as either vice president, I think he's geared up towards some cooperation on here too. So I think you'll see even a different White House in 2022.
Reversion to the mean. You started out at E.F. Hutton. You know, when E.F. Hutton talks, people listen. Blah blah blah. I mean that quote will take back a ways. But we have seen a real uptick in retail participation in the stock market. It's about 25% right now, and I'm wondering what your views are. If you can take off your bond hat for a minute and put on your stock hat for a minute. Do you think we go back to valuations? Do you think valuations in the stock market will also revert to the mean?
Yeah, I think things happen over time. I mean, certainly valuations, if you're talking about things like PE ratios and other traditional things that I don't want to say have been thrown out the window, but you think about where you were, right? And I'm simplifying this somewhat, but if you think going all the way back last year, if you went back to last summer, in August, you had the 10-year bond at 0.5%. So if you're using that or something off of that as your discount rate, and you have earnings from a lot of tech companies growing at double-digit rates, so far, far, far exceeding any kind of rate you're doing at discounting, you get this. So if somebody in August of 2020 said, boy, it's 0.5% on the 10-year bond, I can go buy the Nasdaq 100 and its price is high, but you know what? That's yielding me 0.5%. So just maybe in the next 10 years, I will get, some growth and appreciation in those 100 companies, and I'll still get the same yield as I got on the 10-year bond. Now, as soon as you made that judgment, you immediately got about an 8% correction in the Nasdaq. So you'd say, boy, did I do the right thing? But if you hung on, you've done well. We know that stocks over time do well. And regardless of the calamity, they come back because of the growth in the economy and the fact that the country grows. By the way, one of the best things about our country versus other countries is even though our population growth rate is very small, it's better than anybody else's. And that helps over time too. I do think, though, there's this reversion to the mean. You talked about the retail investor. We always hear that Main Street doesn't participate in the equity markets like Wall Street does, right? And that this growth doesn't mean that much. I think that's changed a little bit at the margin, and you do have more retail participation. Does the average American, when they're back at work, have the time to trade stocks? I think maybe it means maybe a little more for managed money. Maybe people say, I don't have the time to do this. I'm at the desk and I don't have time to log on to my Schwab account every other minute and trade something. I'm going to have to do this and I do believe you'll see some more continued working at home. But I think at the margin, people do float back into the office. So I just think that this return to normal also probably means some return to normalcy in valuations. I mean, I'm not the equity guy. How many more subscribers does a Netflix have on when people are back working? How about people going to conferences? That's more. In other words, the things we had as normal were all subtracted from our time of day. They're going to be added back into our time of day. Maybe not at the rate that we did that, but that's including some business travel. That's including going to some conferences. That's including doing training at work. That probably hasn't happened. Maybe it's happened by Zoom, but yep. So anyway, that's the way I think. I don't think that's necessarily a warning bell for the stock market, because I think the stock market could do very well with slightly higher interest rates over time. Remember, it's not the fact that you'd have higher interest rates; it's the speed at which you would get to higher interest rates.
Mm-hmm. So
which I think will be.
So winding down here, I'm curious because we've had this massive flight to the exurbs, and Boise, Idaho's hot. And so this trend was pretty amazing to see, this flight out of urban centers. But now you're seeing headlines that say, the cities are starting to come back. So what do you think the municipal bond market's is it gonna be a more balanced market than we've seen for a generation?
No, I think it's going to kind of go back to where we were slowly over time. You made a great point, and I think I saw the same CBS piece on Boise that you did, and it was remarkable. This gal sold her house for a heck of a lot more money than she thought she would, and got a deal where she could live in it for another 6 months before they took it over. So I mean, the sellers control everything. You've seen that even in the big centers like New York and Boston, et cetera. So for years in the New Jersey area where I used to live, so I know a little about it. If you went back 25 years ago, you saw a lot of people leave not just the city, but also the train line suburbs, right? Where you could even get easy access to the city. They were leaving and they were moving out, 50, 60 miles out. And they weren't moving to McMansions, they were moving to mansions. These are wealthy people, but you didn't see your neighbors. You had all these, developments where, acres and acres, for each house and all this. And that was the hot item. Jump ahead to the 10 years or 7 or 8 years, certainly pre-COVID. And what was that trend? As we talked about it before with Houston, that was people wanting to come back to the cities. That was the growth of the cities. That was people's kids going to the cities. I want to be closer to my kids. I'm retired, or I don't have anything at home. I'll move to the city. It's that idea. And that happened. And you couldn't give away those big mansions for about 6 or 7 years. And we heard stories of people that bought stuff in the late 90s for $2 to $3 million, and we're letting them go for like $1 million to $1.5 million. Think about that trade for a minute. Over 20 plus years, you were losing 40 to 50% on a house, and not even counting what you've lost to inflation. So that's a remarkable trade. By the way, that trade undid itself in all of 2 months, and everybody wanted to be back out where I don't see my neighbors, I have an office and stuff. So whether you're sitting in the hills outside of New Jersey, or you're sitting in Montauk, Long Island, or up in the Catskills, from a New York standpoint, someone says, boy, I've got all I need to know. I can work here. I'm not going back into the city for years. Maybe not the rest of my life, or just a few times a year if I have to. I think that changes when you're sitting out in those places and suddenly a deal gets done. And we know these firms are going back. And when a deal gets done that you're not part of, and this can be at a brokerage firm, this could be at a bank, this could be at an architecture firm, this could be anywhere, consulting. Something happens and you're not a part of it because you're not back in the office. I think the next thing you say is, I got to get myself an apartment in the city or do something because I've got to be back in somewhat regularly. And I think you've seen that just in New York City, because you have now gone through 6 months in a row of rising co-op prices, not back to pre-COVID, but rising from the 30% down where they were. And rents, and I can tell you this just from my oldest daughter, spent the winter in Vermont skiing and working remotely, and working very hard remotely, but was moving back into New York and got an apartment. And I said, you need to give up a weekend of skiing and get back and get an apartment, because you'll never get the deals in the spring that you're going to get in January or February. Well, they came back in May and got it, and basically got a nice apartment at pre-COVID rent, and didn't get any deal. That tells you something. That tells you that markets are responding to people. I heard plenty of vulture people trying to buy, $5 million apartments for, throwing bids out for $3 million to see whether they could get a counter. That type of stuff. And I think at the margin, people want to be back at cities. Look, most businesses, and the investment management business is the perfect example, are apprenticeship type businesses. We have survived because of technology over the last year and a half. And it's been good, and firms have done well. Why have we done well? Our expenses have been lower. It's very simple on that. and our revenues have stayed the same or gotten a little better. For a while now, you're going to want to have people back. And yes, at the beginning, your revenues will grow, but your expenses might grow a little more as people come back. But what you haven't had, at least in my opinion, is the ability of people and professionals to grow because, Helen is sitting next to Joe and learning, this kind of portfolio management. That's been more treading water for the last year. And people's professional skills and professional growth will now start to increase again. And that's a productivity. I think that's another productivity thing coming on top of everything that we've learned from Zoom.
So one last question. So if cities are coming back, John, we're going to flash a graph up on the screen here. But if cities are coming back, this is important because we talk about this subject often. Can we bring baseball back? Because
Sure.
Viewer attendance at baseball games is just it's been slumping for years. But I'm kind of hoping you can give us some insights about what the future of baseball in America is.
Well, there's a rebound factor, right, as you come out of the economy. So go look at the Texas Rangers stadium, right?
Mm-hmm.
So we'll pick on your hometown. Now they sold out their first games, but they continue to have very good numbers. Why? Because when baseball started, they never put restrictions on people going. Let's counter that with the Tampa Bay Rays, who are here, who have an indoor stadium, so they were uber careful and stuff. So I shared some tickets with some people. I went to some games in April. Not too many people there, and most of you got to sit down, and most of the seats were, with like almost chain-like twist ties and just cut off. I went to the game the other night versus the Red Sox. I'm not telling you that it was crowded, but it was 4 or 5 times as many fans there now in June as there was in April. The traditional places where fans' attendance is an issue will continue to be an issue. That's regardless of COVID. That's the quality of the team. That's the marketing of baseball. I can tell you, if you want to go see a game in Fenway Park and you don't have access to tickets, you're going to pay a couple $100 a ticket through a broker because that's the demand that there is in Boston to go see the Red Sox. So some of that pent up, certainly. But, the Red Sox were doing fine beforehand trying to go to games. So I don't think I continue.
Red Sox, Yankees.
And the Yankees and the Mets will be the same way. I do think, does baseball think they have a problem with a time being too long in the game? Certainly. That's one of the reasons you see the guy in second base that starts out an extra inning. That's why you see a stopwatch on the pitchers. They can't take that much time. They have, I think, 30 seconds between pitches. It's all to speed up the game. So you don't hear Michael Kay of the Yankees say at the end of the game, and the final score is this, and in an interminable 4 hours and 14 minutes. And I think, you want to have a low 3 handle on that. And that's really how they will. I don't think you have to rebuild baseball. You have to tweak it a little bit because, at the margin, it's still a great game.
Awesome. All right. Well, I look forward to Grand Lake Stream.
Same here.
And it was great visiting with you, John. I can't wait to see you in person. Take care, and thanks so much for sharing your insights today. Really appreciate it.
Thanks, Danielle. I appreciate it a lot.
Thanks.
See you soon. Okay. Bye-bye.
Well, everybody, thanks so much for sticking around, watching me and John Mousseau, shoot the breeze. I hope you enjoyed it. Study up on municipal bonds if you don't know them. The market has absolutely been on fire in a post-COVID world. There's a lot of concerns that our taxes might be going up. So if you're a young investor, it's definitely an area that you should be looking into going forward. If you liked my discussion with Moose, as his friends call him, then you would also enjoy a recent episode of Down the Middle with Christopher Cole of Artemis Capital. So give that a watch if you missed it. And I look forward to the next time. If you haven't subscribed, please do so. And I will see you next time around. Thanks so much.